Against this backdrop and based on our continuing assessment of the macroeconomic situation and financial market conditions, we propose to take further measures with the following objectives. 1. To maintain adequate liquidity in the system and its constituents in the face of COVID-19 related dislocations. 2. Facilitate and incentivize bank credit flows. 3. Ease the financial stress. And 4. Enable the formal functioning of markets. The first set of measures relate to liquidity management. So we have therefore decided to undertake what we call TLTRO operations 2, that is TLTRO 2.0. Accordingly, it has been decided to conduct targeted long-term repo operations TLTRO 2.0 for an aggregate amount of rupees 50,000 crore to begin with. The funds availed by the banks under TLTRO 2.0 should be invested in investment-grade bonds, commercial paper and non-convertible debentures of NBFCs with at least 50% of the total amount availed going to small and mid-sized NBFCs and MFIs. So therefore, the emphasis will be to see that there is adequate flow to the mid-size and the small NBFCs as well as to the MFIs. The next announcement relates to refinancing facilities for all India financial institutions like NABARD, SIDBI and the National Housing Bank. In view of the tightening of financial conditions in the wake of COVID-19 pandemic, these institutions are today facing difficulties in raising resources from the market. Accordingly, it has been decided to provide special refinance facilities for a total amount of rupees 50,000 crores to NABARD, SIDBI and NHB to enable them to meet sectoral credit needs. This will comprise of rupees 25,000 crore to NABARD for refinancing regional rural banks, that is RRBs and cooperative banks and microfinancial institutions. Rupees 15,000 crore will flow to SIDBI for on-lending and refinancing, and as you know, SIDBI will be lending this money to, by way of providing refinance to scheduled commercial banks as well as to other financial entities, NBFCs, MFIs, etc., who sanction loans to the MSME segment of the economy. And NHB will be allotted rupees 10,000 crore for supporting housing finance companies, HFCs. And this is very important, relates to the LAF, Liquidity Adjustment Facility. Now, in order to encourage the banks to deploy these surplus funds in investments and loans in productive sectors of the economy, it has been decided to reduce the fixed rate reverse repo rate under the Liquidity Adjustment Facility by 25 basis points from 4% to 3.75% with immediate effect. So I repeat, the reverse repo rate is being reduced by 25 basis points from 4% to 3.75%. The policy repo rate, however, remains unchanged at 4.4% because that is a matter which is decided by the MPC, and also the marginal standing facility rate and bank rate, they also remain unchanged at 4.65%. It has now been decided to increase the WMA limit of states by 60% over and above the level as on March 31st, 2020 to provide greater comfort to the states for undertaking COVID containment and mitigation efforts and also to plan their market borrowing programs better. This we expect will help the states not to bunch up their borrowing program in the early part of the year, but to space it appropriately as per their requirement. The increased limit will be available, that is this increased limit of WMA up to by 60%. This facility will be available till September 30th, 2020. The Basel Committee on Banking Supervision has taken cognizance of the financial and economic impact of COVID-19 and very recently announced that the payment moratorium periods, public or granted by banks on a voluntary basis relating to COVID-19 outbreak, can be excluded by banks from the number of days past due in respect of NPA recognition. Therefore, it has been decided that in respect of all accounts for which lending institutions decide to grant moratorium or deferment and which were standard as on 1st March 2020, the 90-day NPA norm shall exclude the moratorium period. That is, there would be an asset classification standstill for all such accounts from 1st March to 31st May 2020. NBFCs which are required to comply with Indian accounting standards Ind AS may be guided by the guidelines duly approved by their boards and as per the provisions and as per the advisories of the Institute of Chartered Accountants of India in recognition of impairments. In other words, NBFCs do have the flexibility under the prescribed accounting standards to consider such relief to their borrowers. The next announcement relates to extension of resolution timeline. Under RBI's Prudential Framework of Resolution of Stressed Assets, dated June 7, 2019, in the case of large accounts under default, scheduled commercial banks, all India financial institutions, NBFCs which are non-deposit taking but systemically important, and deposit-taking NBFCs are currently required to hold an additional provision of 20% if a resolution plan has not been completed within 210 days from the date of such default. Recognizing the challenges to the resolution of stressed assets in the current volatile environment, it has been decided that the period of resolution plan shall be extended by 90 days. The details of this announcement will, of course, be spelled out in the circular which will be issued. The next announcement relates to distribution of dividend. It is imperative that banks conserve capital to retain their capacity to support the economy and absorb losses in an environment of heightened uncertainty. It has therefore been decided that in view of the COVID-19 related economic shock, scheduled commercial banks and cooperative banks shall not make any further dividend payouts from profits pertaining to the financial year ended 31st March 2020 until further instructions. This restriction shall, however, be reviewed on the basis of the financial position of banks for the quarter ending September 30, 2020. The next announcement relates to LCR, Liquidity Coverage Ratio. The LCR requirement of scheduled commercial banks will be brought down from, it is being brought down from 100% to 80% with immediate effect. I repeat, LCR requirement is being brought down from 100% to 80% with immediate effect. The requirement shall be gradually, however, restored back in two phases, 90% by 1st October 2020 and 100% by 1st April 2021. The next announcement relates to NBFC loans to commercial real estate projects. In terms of extant guidelines for banks, the date for commencement of commercial operations, DCCO, in respect of loans to commercial real estate projects, delayed for reasons beyond the control of promoters, can be extended by additional 1 year over and above the 1 year extension permitted in the normal course without treating the same as restructuring. And restructuring, as you know, would obviously have implications for asset classification. It has now been decided to extend a similar treatment to loans given by NBFCs to commercial real estate. This will provide relief to NBFCs as well as to the real estate sector.